gamma pins, how do they work, and why is this not a gamma pin? Now, gamma pins are gamma pins until they're not, all right? Gamma pins will stay a gamma pin until the order flow drastically changes, okay? So first of all, let's go over what a gamma pin is, and then I will tell you why the gamma pin was lost. Actually, it was lost today, right before the video started, actually. That's when it got lost. And I will go over that with you right now, okay? So I made a little slideshow here. Ooh, fancy. Okay, so gamma pinning. So first of all, what is gamma? Okay, so gamma expresses the change in your delta of an option for every incremental move in the underlying. Generally, it's for every 1 point. For stocks, that would be $1 if you're here in the United States. All right. So for every $1 move, how much does your delta move? All right. For every dollar, for every point on Bitcoin, how much is your delta of your option moving? That's what gamma expresses. Okay. For those of you that are math nerds, it is your second derivative of your price function. Your first derivative being delta. Okay. So you can think of delta as like your velocity of your car, and then gamma is like your acceleration. How much your velocity change, at what rate does your velocity change? That's what acceleration is, right? So that's your second derivative, right? So for you math nerds out there, okay? If you don't understand what that meant, just know that gamma is, just remember this part, okay? Just gamma is the change in delta of an option for every incremental change in the underlying, all right? So I just give you an example right here. Let's say you have a call option at delta 0.5 and you have a gamma of 0.1, all right? If your stock moves up $1 and everything else stays constant, like, it's not a different day, it's the same day, volatility doesn't change, all the other variables that go into pricing an option, none of those change. If everything is held constant, then the new delta of our option after the price move is 0.6. Okay? So the opposite of this is if you have a call option for delta 0.5, gamma 0.1, same option, but it moves down $1, then instead of your option delta being 0.6, is going to be 0.4, right? Okay, so that is the how you use gamma and delta. Now, again, this is super simplified, just for example purposes only. Okay, so for super simplified, all right. So generally, when do we have a situation where everything is just constant? That only exists in the theoretical world. In the real world, every variable is moving constantly, okay? So again, this is just super simplified, all right? I go over another example for a put option. Put option, same thing. Your put options have a negative delta, right? Call options usually have a positive delta from 0 to 1. Put options are negative delta from 0 to 1. So if you own a put option and it's negative 0.5 delta and it's got a gamma of 0.1, if the stock moves up $1 and everything else is constant, then the new delta of our option after the price move is 0.4, right? When a put option, if you own a put option and the price of the underlying, because a put option is a bearish position, right? So if your stock goes up after that, your option gets worth less, right? So your delta goes down, all right? Now, same thing, if your put option, if you got the same put option, delta minus 0.5, and you have a gamma of 0.1, and your stock moves down $1, okay, then the new delta of our option then would be negative 0.6. Actually, that should say negative 0.4 if it moves up, right? Hold on. Let me change that. Okay. Okay. All right. Oops. So that is now correct. All right. So again, put options have a negative delta. So if it goes up, you add 0.1 to negative 0.5, you get negative 0.4. If it moves down $1, well, you take negative 0.5 and you subtract 0.1 and you get minus, negative 0.6. Okay? Is that clear? Thumbs up or thumbs down, voice chat, text, or on Twitch or on YouTube. I'm looking at all three right now. Thumbs up, thumbs down. Do we all understand this? Thumbs up. Good. Okay. So you all understand. Okay. So, and again, just think about this. Think through these examples. Okay. So if you don't understand, if you don't want to, if you're shy, just, rewind the tape, go over that example again, and just read through these examples. Okay. Now, here's the thing about gamma. All right. Gamma increases drastically on close to at the money options as we get closer to expiration. Okay. Remember back in the day when the VIX was a little bit lower? Remember how we used to play those 0 DTE SPY calls and puts? For those of us, for those of you guys who've been with me for a while now, what you're really doing was taking advantage of how gamma affected delta in the last 30 minutes of the day on the expiration days. Okay, that's really what we were doing. All right, we were just taking advantage of that gamma explosion. Okay, so gamma drastically it goes up, so which means that deltas change very quickly for close to at the money options as we get closer to expiration. Let me say that again. Because gamma increases drastically as we get closer to expiration, deltas of close to at the money options also change drastically as we get closer to expiration. Okay? So what did I tell you about market makers? What is the number one job of a market maker? Is to facilitate trade and to take the opposite side of the trade, which means they have to have a bid and ask, which means they always take the opposite side of the order flow. All right, and they always remain neutral. How do market makers make money? They make money off the volume, off the bid-ask spread. Okay, they don't take a directional bet usually. They want to remain neutral. They want to remain delta neutral. Their delta, at the end of the day, they want their delta to be zero. Okay, with all these pluses and minuses, it all has to equal out to zero. So when your delta is moving so much, how do we hedge that? Well, here's the thing. All right. So let's go over an example. Okay. And this is in the perspective of the market maker or the institutional trader. Okay. If a trader owns a delta 0.5, gamma 0.05 call option, okay, that means that they are hedging with 50 shares short of the underlying. Now let's conceptualize this, okay? If you are long a call, in order to hedge on that long call, because a long call is a bullish position, you would need a short position on the underlying to neutralize it, right? So that's why when you're long a call, to hedge, you're going to be short those shares or short Bitcoin, okay? So delta tells you how much your option price changes based on a 1 point movement in your underlying, okay? So if you have a delta 0.5 option and it's a call, and you own this, if price drops by 1 point, your option will go down by a value of 0.5. Okay? So how do you negate that? Well, in options and stocks, each option represents 100 shares. So if you have a delta of 0.5 and your price goes, let's say your price goes up, the stock goes up $1, well, now your delta is 0.55, right? Because your gamma is 0.05. So you went from a delta 0.5 option to now you're a delta 0.55 option, okay? But you're only short 50 shares, okay? So as the price goes up $1, right, you've gained $1 on your option, right? You've gained $50 on your option. So to hedge that, you're gonna have 50 shares short. So you lost $50 on the underlying, right? So when you go from zero, so now to hedge at this point at delta 0.55, you have to short 5 more shares to remain neutral. So as it goes up, as the delta increases drastically, the market maker has to sell more of the underlying, and so that's why price comes back to its pin. Okay, so this option at 0.5 is strike 100. So generally when your delta is at 0.5, that's an at the money option. Okay, at the money options are generally 0.5, the delta. All right, you can think of it as it's got a 50-50 shot of being in the money or out the money, right? Because it's right there, it's right on the line. Okay, so we're at strike 100. If your call option goes up to or the underlying goes up to 101, now your delta is 0.55 based on your gamma. All right, and so now to remain neutral, you have to short 5 more shares. All right, now same thing in the other example. Let's say you own those calls at 0.5 delta, gamma 0.05, you're short those 50 shares to hedge and to remain neutral. If your call, so let's say you're at this point right here. I don't know if you can see my mouse cursor, but right here, if you're at this point right here between 2 days till expiration and 1 day till expiration, if you're right here at 100 and prices fall, well, now your option is at 0.45 delta. You've lost money on your option, but you gained money on your 50 shares short. So you lost $50 on your option, but you gained $50 on your short position. That's because you're neutral. But now at this point, in order to remain neutral, you have to buy 5 more shares to cover because your delta has been reduced on your call option. Do you see that? And so because you're covering 5 shares, you have to buy, it comes back to the pin. It comes back to the pin. So this is why pins happen, all right? And the same thing with puts, all right? If you're in a delta 0.5, gamma 0.05 put, if you own a put, to hedge that put, you're going to be long 50 shares. Right? Because a put is a bearish position when you own the put. So you need to have a long position to remain neutral. All right? So let's say you own the 100 strike and it's at 0.5. And let's say price goes up from 3 days till expiration to 2 days expiration. We see the put will go from 0.5 to 0.45, right? Because we lose value on that put. But luckily, we had 50 shares short. We had 50 shares long. So even though we lost money on the put, we gained money on the long position. But now that our delta is 0.45, we actually have to sell 5 of those shares to remain neutral going forward. And that's why when we sell those shares, the selling pressure causes us to go back to the pin at strike 100, the at the money pin. Same thing, if we're here between 2 days expiration, 1 day expiration, we're right here at 100. Same thing, same puts, delta 0.5 puts at gamma 0.05. We are long a put and we're short 50 shares. We're long the put and we're long 50 shares of the underlying. If the prices come down, our put has just gone from 0.5 to 0.55. Okay. And now, in order to remain neutral, they have to buy 5 more shares to remain neutral at delta 0.55. And again, it's going to put that pressure to go back to the pin. All right. Now, I hoped to show Bitcoin as the example of that. I was hoping that the pin would remain intact for this presentation, but that is not the case. Oh, okay. First of all, let's go back to that. Why is it that the pin doesn't remain? So here's the thing: as long as the volume of this options activity, of all this pinning, as long as the volume of that exceeds the order flow volume, the pin will stay until expiration. Again, if the hedging activity, the volume that's caused by the hedging activity, if that is significantly higher than the order flow, if there's not much new order flow coming in, and it's just a boring market day, that pin is going to hold until expiration. Okay. Now, when does the pin not hold? It's when new order flow comes in. Okay. And we saw new order flow actually coming in right before the video, actually about an hour or so, maybe a couple of hours before the video started. We saw huge amounts of our order flows coming in. Actually, I'll tell you which order flow is coming in. A lot of the 23,000 calls it's almost like they're sick and tired of buying the 22,000. Now they're getting even more bullish at 23,000. So we saw even more call buying. New order flows came in, much more heavy in the call buying area. And so what did I tell you guys? If there's a lot of call buying order flow coming in, what does the market maker have to do? The market maker has to sell those calls. If the market maker is selling calls, that's a bearish position, so they need to buy Bitcoin to remain neutral. Okay, so that's why we kind of got rid of our pin, and now we're still rising. Okay, we're still going up. Okay, but we did have a pin situation for the past few sessions, or past couple of sessions at least. Right here we had, well, let's not look at the hourly. It was less than, so from, basically from about Monday, we saw that pin. See that? Around 22,000. Every time we go low, all those call buyers, they have to buy more of the underlying to cover those put. The put holders, they need to buy more to remain neutral, and then also too, when it got too high and when those deltas changed, they had to short. So we saw this pinning action happening the whole time. Okay. Again, I was hoping to use Bitcoin as our example. With the order flow and everything, I was going to show this with Bitcoin, but we lost the pin. So now I got to find another example. So I got to go back on demand and find a place on like SPY or something. It usually happens a lot on indices where there's a lot of options participation. So I will try to find an example. I didn't actually have time to go on demand. Again, I thought I was going to be able to show you guys on Bitcoin, just on this. I thought the pin would hold, but I guess not. Animal spirits have taken over, and people are just buying calls like crazy. 23,000 now calls, getting a lot of action for this week. Look at that. Woof, look at that. That is some action. People are betting hard on this, okay? Let me see if there's any questions. Can you show a real-world example of finding the gamma? Okay, so yeah, I mean, again, like, okay, so like, I wish there was like go back in time feature on Deribit, just like, think or swim. But if you looked at yesterday's numbers, or even like before, like right before the market opened, there was actually like the most of the volume was around here. Your biggest volume number was actually around here. On the puts, it was 591. Actually, here, I think really early in the morning, like in the wee hours of the morning, this actually said like 800s, 900s. This is only the volume on Deribit. They only report the last 24 hours. So probably like, from now, like maybe like 28, 29 hours ago, something like that, right? Maybe about a day before, some of that was counted, and so. In the wee hours in the morning, it said actually around 800, and there was this wasn't as high. This was nowhere near as high, and the two big volume strikes were 22,000 on the call side, 22,000 on the put side. That's how I saw the pin. Okay, that's how I saw the pin, and not only that, on the order flow, you actually saw primarily a lot of buying and selling back and forth of these puts and calls at 22,000. That's how you know it was a pin. And then also too, if you look at the price action, boom, 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 it's just going around that 22,000 strike. So not only, that's what you look for in a pin. You look for the highest volume being at the money on both the call and put side. You're seeing lots of orders buying and selling on the calls and puts of that strike, and you're seeing the price just bouncing between that. That's how you know it's a pin.